The selling accelerating on Wall Street as we head into the close. It's this risk-off trade as rates hit their highest level in almost a year. One area that's hit especially hard today, crypto. Jared Blickery is on the floor of the New York Stock Exchange with the details. Jared, take it away.
I haven't talked about crypto in a while. Let's take a look at the Wi-Fi Interactive, where we are seeing some definite downside action in not only Bitcoin, but Ethereum, each down about 4%. And here is a 3-month chart of Bitcoin. And you can see after reaching this local peak here in early July, it has just been a steady slog down for Bitcoin, now reaching the lowest levels in about 2 months and also having the worst day in a month. Just haven't seen much volatility lately. In fact, most days you see crypto doing practically nothing. So kind of in and of itself, something worth mentioning. Couple things on the horizon here. We just got Coinbase, one of the biggest brokers in the world, and also an exchange, got permission from the Commodity Futures Trading Commission only yesterday to become a futures commission merchant. So this is going to mean that they can sell to their customers futures contracts in both Bitcoin and Ethereum. Anything else that comes down the pike that's authorized by the CFTC. Doesn't really change the regulatory game that much. They still have problems with the SEC, but it does kind of make the SEC look out of step. So let's get back to the charts here. Here's Bitcoin. I was showing you the last 3 months, but interesting thing that's happening over the last year. Guess what? We are now poking just below this lower trend line. So really the bulls want to get above 28,000, 28,500 pretty soon here. Otherwise, it's going to start looking like a breakdown. Now, crypto is known for a lot of false breakdowns. I'm always on alert for one of those, and that usually happens over the course of a few days. So we'll look to see what's happening here in the crypto universe. I can also take a look at some of the crypto stocks. This is just what's happened today. Some of these names like Riot Blockchain down 10%, but a lot of these names have simply been decimated. Here is a year-to-date look, though. You can see huge gains. Let's take Mara, for instance, Marathon Digital Holdings. The local minimum was in January, had a big peak in July, but most of these assets have sold off in the general risk-off fever that we've had. And a lot of that simply has to do with interest rates. We've had the long end of the curve. This is a 10-year T-note yield over the last 3 months. This has been absolutely screaming higher. That puts pressure on Bitcoin. Bitcoin does not offer a rate of return, so the thinking goes, well, higher rates, missing out on something there. There is another alternative. So just in general, when we have these rates screaming higher, it's an easy excuse to sell Bitcoin, and perhaps that's what's happening here. But really want to see 28,500 in the near future for Bitcoin bulls, guys.
All right, Jared, with the levels for us to watch, Jared Blickery at the New York Stock Exchange. Thanks so much. Mortgage rates topping 7% this week, hitting levels that we haven't seen in more than 2 decades. The average rate for a 30-year fixed mortgage rising to 7.09%. That's the highest point that we've seen since April of 2002. And it's just the 3rd time that rates have exceeded 7% since then. For more on what this means for the broader economy, we want to welcome in Jose Torres, Interactive Brokers senior economist. Jose, it's great to see you again. So let's talk about the fact that we're seeing mortgage rates once again on the rise, reaching levels, like I just said, that we haven't seen in about 21 years. What does this do to the housing market? Then what does this do to the broader economy?
Thanks for having me. Well, unfortunately, rates this high, what it does is that it constrains the housing market. And right now, you have existing homeowners they're stuck with low rates and they don't want to sell and then have to go assume thousands more in monthly payments on another property. So that's constraining transactions in the existing home sale market. Now, the new home sale market is doing a little better this year. However, affordability just remains too constrained with rates above 7%. Like you said, these are rates that we haven't seen in a really long time, pre-Great Financial Crisis, and it constrains the real estate section of the economy, which makes up about 1/5 of it. So anything from construction workers, durable goods manufacturers, materials folks, everything that's related to real estate starts to deteriorate whenever you have transactions down this much. Now, another difficult situation is the fact that rates can continue to go higher. You have the Fed not buying long-term bonds. You have the US Treasury with a high need to borrow, and you also have sticky inflation. So long-term rates could go higher from here. So I'm a little nervous if rates go to 7.5 or 8. That we'll have some price corrections in the real estate market.
So what's the expectation for what would happen if it went to, I almost want to say, God forbid, 8%? That's, I mean, you know, I haven't seen levels like that. I want to say in my lifetime, but I was living in the 80s, so I know it's been worse. But what's the expectation for what it would do to the housing market, given the constraint we already see there?
And to your point, a lot of folks say, well, you know, we've had rates like this in the past, but what we haven't had is rates and prices this high simultaneously. And I think that's the important constraint. And the longer that rates stay above 7%, or even if they go to 7.5 or 8, you know, you're going to have some problems. You're going to have some forced selling eventually, maybe not in the single family market, but in the multi-family market where you've had a lot of construction, you could have some forced selling there. You could have some forced selling in Airbnb. On the commercial side, a lot of the rates are floating rates. So a lot of folks that made investments in 2021 with rates at 3%, now that's repriced to 7 and 8%. Maintenance costs have gone up, insurance costs have gone up, and it really weighs on the real estate sector overall.
So, Jose, we have some worry just about what the real estate sector is going to look like here, at least in the short term. But when you take a look at some of the recent estimates that we're getting out, Atlanta Fed seeing third quarter GDP growth of 5.8%. We talk about the fact that the economy has certainly surpassed many forecasters' expectations up until this point, but 5.8% growth, is that realistic?
No, it's not realistic, and Atlanta GDP tends to be very, very hot initially sometimes, and you know it could be very volatile. It's not realistic. Now, what is true about what you said is that a lot of us have been surprised by the strength of the consumer. You know, we didn't think that the consumer would be able to digest all these rate hikes and have their pandemic savings begin to dwindle and rack up all this credit card debt. And then you also have looming student loan payments coming on in October. So we've all been surprised, but I think that the consumer is going to begin to slow down after Labor Day more significantly. I'm starting to see that in travel bookings and restaurant reservations. We're starting to see at the margins the consumers start to lose momentum. And that I think it's going to happen at the same time that the long and variable lags of the Federal Reserve's monetary policy start to hit the economy. So we could have a soft patch in late 23, early 24.
And how does that bode for the overall economic picture, especially to your point, there's data out from the Federal Reserve Bank of San Francisco pointing out what's happening with regard to that weakening in savings that we're seeing and the spin off of that excess savings that people had during the pandemic. What is the expectation for where we land by the time this year closes out economically?
You know, I think the consumer is going to stay afloat, and I think the saving grace for the consumer is this hot labor market that we have. And businesses are immune to these interest rate hikes at this juncture because they're flush with cash and they want to earn returns, and there's labor shortages. So consumers, even if they're having affordability troubles or budget constraints, they can still go out there, get a job, have some good, strong wage gains to offset a lot of those pressures. So I think that if we do get that soft patch in late 23, early 24, it's not going to be a type kind of recession that we're used to seeing where there's a lot of joblessness. We'll have a slight tick up in the unemployment rate, and folks will feel it more from an affordability standpoint. They'll start to trade down. Companies will start to invest a little less, but it won't be significant unemployment like we've seen in previous cycles. The demographics just don't support that, and corporate appetite to earn returns and make money is just too high right now.
Jose, there's this long-going debate right now about excess savings and what exactly those levels look like. Some, like you have the San Francisco Fed here, saying that there's not much left. You have others that say actually the situation looks okay. Does this argument or does this debate still matter as much given the fact that we have seen inflation pretty steadily ease here over the last year or so?
Yeah, I think it matters. And I think the reason it matters is what's the cost of bringing inflation down, right? And some of it is corporate pricing power declining, margins contracting, earnings not being as good. And then of course consumers not having that tailwind of nominal prices going up and all of their incomes going up. So as inflation comes down and those interest rate hikes and that balance sheet reduction and also the credit crunch that we've been experiencing at the margins due to the regional banks, when that starts to hit, all at the same time that the consumer is slowly weakening, that could pose some risks looking forward. But also, the market is doing very well this year, we're in a soft patch now, rough seasonal period, but the market's doing really well and young folks are involved and they're happy that the market's going up and that's giving them extra purchasing power. Also, the propensity to save isn't that high because the housing market is so out of reach for so many individuals. Durable goods also out of reach for many individuals. Cost of financing too high, prices too high, access to credit not as high. So those things in combination make it where consumers want to invest on services. They want to travel, they want to go out and eat, they want to enjoy themselves. And that's what's been most problematic with inflation has been labor-intensive services. And that's what we've been seeing consumers do in an environment where houses and durable goods are too expensive.
Yeah, we certainly have seen that reflected in the recent numbers. All right, Jose Torres, Interactive Brokers senior economist. Thanks so much. Well, coming up, streamers keep raising their prices. So is it time to maybe reconnect that cable box? We will discuss the new phase of streaming wars on the other side. The cost of streaming is going up. Disney is the latest player to announce price hikes, raising costs for ad-free Disney Plus and also Hulu each by 20% or more. Peacock, Max, Paramount Plus, and Apple TV Plus have all raised their prices in the past year. And the Journal estimates that the average cost of major ad-free streaming is up nearly 25% in a year. For more on this, we want to bring Yahoo Finance's Dan Halley and Alexandra Canal to take a look at all angles of the streaming wars and how much people are paying right now. But Dan, when it comes to what's going on right now, how much more people are paying, what are we seeing? And I guess what kind of behavior maybe could we expect?
It's basically up across the board for every major streaming service. It started more or less last year when Netflix raised their prices. Their premium plan went up to about $20. Then they started saying we're going to crack down on password sharing. They introduced their $6.99 ad-supported plan. Now, if you try to share your password, you're going to have to chuck an extra $7.99 in there. Sorry, Mom and Dad. Then we also have Hulu. They raised their prices last year, along with Disney. Disney just did that again. We have Max, HBO, whatever they want to call it. They raised their prices. Peacock, who's subscribing to Peacock, but whatever. They also raised their prices. And then YouTube TV, which I subscribe to for the Mets, raised their prices. I ranted about this, though. The Mets and SNY can't come to an agreement.
That's an expensive.
It is an expensive subscription. Like the YouTube TV one, it's the one that stood out to me. Go ahead, Dan.
It's dumb. It's $64.99 to $72.99 for me to watch Naked and Afraid while I drink White Claw and get drunk and laugh at these people in the woods. Is it worth that? Is it worth that?
$72.99.
YouTube TV is supposed to be a cable replacement.
Yeah, it is.
So it's in a different category than your Netflix, your Apple TV Plus. But if you're only using it to watch Naked and Afraid, maybe not worth the $72.
Don't poo-poo getting drunk and laughing at people.
No, I'm not. I use it to watch Summer House exclusively.
Yeah.
So, hey.
There you go.
But all of these make you question which of these do I still need? Like, do I need to have, of course, like Netflix? Well, yes. But, the Netflix, the Hulu, Disney. Do you need, Disney, Hulu all together now, basically. Do we need all of these? And you have consumers starting to, I guess, question these, what we've looked at as not necessarily little luxuries. They're not necessities, right?
They're certainly not necessities, but I think so many people just get used to having these subscriber service, and I'm speaking from firsthand experience, that if these companies do raise it by 20%, the likelihood of you then going on and canceling, they're willing to take that chance. And we saw it here from a number of streamers over the last year. And yes, there has been a little bit of churn, but it's been a smart move on the streamers' part, just in terms of some of the pressure that they're seeing. They're trying to do everything they can to cut their losses, and this strategy is working. It's tough for us, but it's working for them.
And if you think about the password sharing crackdown, I mean, Netflix added 5.9 million subscribers, in a large part due to the password sharing crackdown. So we might not like it, but we're doing it. And you brought up a good point with churn. Obviously, when you raise prices, that's a big risk. It is the critical problem that these streaming companies face. I've spoken to analysts about that. They can't ignore churn. However, I think it's worth noting that all of these subscription services, they have ad-supported tiers now,
right? And
they're cheaper. And one of the reasons why they're raising the prices on the ad-free plans is they're trying to convince consumers, well, don't cut us out entirely. Just watch us with ads. That is a higher average revenue per user. That's that metric, ARPU, very key to profitability. So there's a method behind the madness going on.
Do we think people are going to go back to cable, though? I mean, I actually still have cable.
I don't think we're going to go back to cable, but the thing that's going to start happening is more bundling. We have the Hulu, Disney, ESPN Plus bundle. You're just going to see more of that, whether it's with carriers, whether it's through different platforms, and that's how it's going to be. And then some of the folks that I spoke to said, think multi-year now contracts, where maybe you lower the monthly price, but you're hooked in for 2 years, and then
that's the cable model.
Exactly. So it's all going back there. And I think one of the things with churn, I'm thinking about this is, Netflix said that they're working on their cloud gaming initiative. Well, it's not because they want to compete with Microsoft and Sony. It's because they don't want you to leave when you got Stranger Things on there. I went through, we were talking about this earlier, I went through the carousel the other day of all the Netflix originals. It is trash, just complete trash. There was like one thing that I watched.
But you have a lot of content, right?
And that's a thing.
And there's going to be new churn data out next week that I'm going to be tracking. But I have something right now from Antenna, and this is monthly signups. Out of all the major streaming services, Apple TV Plus saw less monthly signups in June than they did a year ago. Everyone else is up.
Yeah.
And even though Apple TV Plus, the content's really good, there's not a ton of it. And I think that's a big factor when people are weighing their decisions here. But bundling, absolutely. I hear that from literally every single person I talk to. That's a new frontier.
It's cable.
Yeah,
Exactly.
exactly.
And then you're going to be paying just as much as you were before, if not maybe even more. All right, Allie and Dan, thanks so much.
All right. Companies from entertainment to engineering are jumping on the AI bandwagon, and they are willing to pay big bucks to get ahead of the competition. Netflix recently posted a senior role in machine learning with a pay range offering up to, get this, $900,000. Here to discuss more is AI researcher and professor at NYU's Business School, Stern, Vasant Dar. Thank you so much for joining us today, Professor.
Great to be here, Diane.
Thank you. And let's get right into this. So this was like when I saw this number, and of course there are other high paying jobs in this industry, but that one really jumped out to me. What do you make of that $900,000 for an AI role?
Yeah, how about that? Right? It's this reminds me of Wall Street in the 90s, right? It's just sort of musical chairs. Now it's big tech. And it just tells you what someone really good is worth to these companies. The stakes are high. So people out there are saying, we need to do something. We need to get really good people, and let's pay them, right? So that's what you're seeing here.
So the stakes are high, but especially when it comes to generative AI, to us, this is a newer kind of frontier. You don't have that many companies that are at the leader of the pack. So how do they know this is the value that this role should have?
Well, that's a great question. So assuming that companies know what they're doing and what they want to do with AI, which is a big assumption, because what I see is people sort of scrambling and say, hey, we need to do something, but it's not clear what they want to do. But assuming that they get some clarity around what AI really means for their business, then these numbers are justified, right? Because the value that someone really good can bring to the table is awesome. Now, the trouble is that there's a high variance in people's abilities and skills to actually translate something into real sort of, money, business profits. So it's not easy to get the right person, but if you can get the right person, then the right person is worth that kind of money. I mean, you can't pay people enough, the right people enough for this thing. There's lots of people out there, but getting the right people, that's the challenge.
And one of the things we're showing right now is a graphic of some of the job opportunities that are out there within AI. And these are on the lower end of the range we're discussing from jobs paying in the $200,000 range to the $400,000 range. So not quite at that Netflix level of $900,000. So what kind of, and the companies that probably come to mind for you, or say, an NVIDIA, what kind of companies really kind of understand this best versus companies that are like, to your point, we got to get in on this?
Well, the majority fall in the second category, right? So most people are saying we need to do something, but it isn't clear what they need to do. While you have some companies who are the leaders and AI is their business, right? So Google, Microsoft, NVIDIA, Amazon, AI is their business. And so they've got the skills, they've got the best talent, and they have no, difficulty attracting good talent. But, regular companies, they have a hard time attracting that kind of talent. So they're willing to pay up.
And I want to ask you really quickly, the flip of this is there was a report out earlier this week about a percentage of companies that have replaced jobs with AI. With the generative AI, kind of the technology versus a person. How effective do you think that can actually be, especially when you also have some issues with regard to AI doing what it says it can do, the problem with making stuff up, the hallucination? effect?
Okay, all right. Well, there were two there were two parts to your question, and I've already forgotten the first one because the hallucinations are so
let's
interesting.
Let's go with
exciting.
hallucination and talk about that piece, because there was a report out today about issues like with OpenAI, these models tested for hallucinations, and they were given questions and they got it wrong.
Yeah, but we shouldn't be surprised, right? We should not conflate the ability of the computer to speak well with knowledge, right? It's like, someone just said that it's like an alien species that's descended on Earth, and they speak such good English that we think they know everything. And they don't. We should not be surprised that they get a lot of things wrong, just like people do, right? People get all kinds of things wrong. So why should you expect, ChatGPT to get everything right? Because it's been trained on everything out there, right? It's learned truths, falsehoods, slurs, everything, right? Mm-hmm. And these are these sort of, what I call pre-trained models that have been, trained on everything out there. And then you get applications built on top of them, like ChatGPT, where you sort of train it to, talk in a certain way. Right. But it inherits all of the, sort of limitations of these sort of pre-trained models that it's built on. And that's the thing to keep in mind, is that, these pre-trained models make it easy to build applications really quickly, but they'll inherit the limitations of these models. And, one of the sort of big limitations of this current sort of paradigm is that despite the really impressive things that AI has accomplished, and the most impressive one is the fact that a machine can actually talk to you, it has huge limitations, right? There are lots of things that it doesn't know, and we don't know the things that it doesn't know. Right? So it becomes hard to trust it. It's like talking to someone really intelligent, but you don't really know whether you should trust them all the time.
That's right. Well, we will have to put a pin in that and explore the trust question later. Professor Vasant Dar from NYU's Stern, we appreciate you. Thank you. And coming up, the closing bell on Wall Street. We are checking in on the latest market moves and the top trending tickers. Stay with us.
That's the closing bell on Wall Street. Once again, we're looking at losses across the board, right around the lows of the sessions, where we're closing with the Dow off nearly 300 points, the S&P off about 0.8%, the Nasdaq, the worst performer of the three major averages. We saw a spike in yields today, putting some pressure on the tech sector. We also saw consumer discretionary as an underperformer. Home builders, many of the larger home builders here, Pulte Group, D.R. Horton, among the decliners in today's action, following that mortgage rate number that we got out this afternoon of over 7%, the highest level that we've seen in 21 years. All right, taking a look at some of the individual movers. Walmart, it's been a top trending ticker all day here at Yahoo Finance, closing the day in the red, off just over 2%. Now, the move lower coming despite the fact that the company beat expectations for the second quarter, also raised its full year guidance. The argument here, Diane, is that a lot of this good news had already been priced in. Expectations for Walmart heading into this report were very high, given the fact that they do focus on value. They do focus on delivering the lowest price possible to the consumer. And many consumers are being forced to trade down, given the fact that they're paying higher prices almost everywhere.
I thought you were going to do their tagline there just now. You're
but
very
they are
close to that. Yeah, I mean, look, we know they did well. They saw better than expected traffic, up nearly 3%. Expectation was up more than 1.5%. You saw growth in ticket, e-commerce growth. So they were firing on all cylinders, and they are positioned well when you think about the consumer who is becoming more cash strapped, more price sensitive, but they have had a run up to their numbers. Now, initially, the initial reaction was positive, but it turned lower along with the broader market. You had that kind of the "what have you done for me lately" theme playing out. Now, the stock is still up nearly 8.5% year to date, so it's still a strong performer year to date, but you didn't get that runaway action that you may have expected to see with a beat like this. So again, investors just, kind of cooling their heels on Walmart. Let's take a look at another stock. Shares of Cisco finishing the day higher after fiscal fourth quarter results beat analyst estimates. The tech giant's first quarter earnings forecast is also better than what Wall Street anticipated. You had another kind of look under the hood with regard to Cisco and just how are they doing with regard to the AI and the networking for them. So, strong performance there from Cisco.
Yeah, certainly a strong performance. We heard from Chuck Robbins, the CEO of Cisco, was on Yahoo Finance earlier today saying that the company is seeing early wins in AI. They're also benefiting from a more diverse book of business. We saw that reflected in these results the most recent quarter. Guidance, though, a bit cautious when you take a look at least to the streets commentary out there, and there still is some caution from analysts. Citi staying neutral, saying that while they are encouraged by these results, they do await market share gains in the switch and security to turn a little bit more constructive. And UBS also maintaining its neutral rating, saying that the report features, quote, some positives for long-term bulls, including better than expected product orders, though the outlook is a bit disappointing. But for the day, we're looking at Cisco closing up just about 3% year to date. This is a stock that's up just about 15%.
Yeah, wait and see.
All right, taking a look at CVS, that stock off about 8% today after Blue Shield of California dropped the pharmacy as its benefit manager for drug prices and other services. Now, Blue Shield of California is teaming up with Amazon Pharmacy and billionaire Mark Cuban's Cost Plus drug company. We're seeing that reflected in the stock today of CVS, some concern there when it comes to, I guess, what this means for Amazon, what this means for Mark Cuban's company, really just the future of this side of the business. Amazon Pharmacy saying that it is thrilled to join Blue Shield of California. Obviously a huge win there for their company, but it's going to help members get the medications they need when they need them at a price that they can afford. So, of course, this begs the question about whether or not we'll see some of the other carriers shift in terms of who their providers are.
Yeah, and then this issue about being the pharmacy benefits manager, what is going to happen in that space now? You had this ripple effect to other stocks in that space. Cigna lost some ground as well. And United Health had earlier fallen under some pressure. Now, TD Cowen put out a note saying that it thinks the share reaction on this decision to drop CVS overstates the earnings impact. So they believe it does create an overhang for shares, but it doesn't believe the long-term model for pharmacy benefits managers is at risk. So it's not playing out reflected in terms of the share price today. But so that will certainly be one to watch in terms of that take. Is it really, like, how risky is this to that model?
Yeah, certainly. All right, let's get back to one of the top stories of the day. Walmart shares closing the day in the red, off just over 2%. The retail giant posting better than expected results, and one of the main driver was grocery sales. And it has been a busy week here in that area of the retail space. Aldi acquiring 400 Winn-Dixie and Harvey's supermarket stores, which will expand Aldi's growing U.S. footprint into the South. It also comes as two other grocers face more headwinds in their mergers deal. Kroger's and Albertsons, 7 states calling on U.S. antitrust officials to block the nearly $25 billion tie-up, claiming that it's going to hurt Americans. Joining me now is Bert Flickinger, Strategic Resource Group Managing Director. Bert, it's great to see you again. So let's first start with what we heard from Walmart this morning, because this massive push that the company is doing in the grocery business, as it stands right now, controls nearly a quarter of the grocery market here in the U.S. Is anything going to stop Walmart's momentum in the grocery business?
Shauna, you're completely correct. Walmart's momentum is unstoppable. And as you referenced, Walmart has the highest grocery sales and the highest grocery market share in the 200-year history of supermarkets and food retailers across America. Amazon's growing as well. And Walmart is site saturated the South, where Aldi's going in after buying Winn-Dixie. Winn-Dixie, as you reported well with Diane, Winn-Dixie had filed for bankruptcy twice. Anthony Hucker came in, brilliantly turned around Winn-Dixie. But Aldi's going into the Southeast in key states, especially in the Gulf Coast region, where Walmart's wiped out, in many cases, the number 1, 2, and 3 ranked supermarket chains: Louisiana, Alabama, Mississippi, Arkansas, et cetera.
So, Bert, where does that leave the smaller rivals? Are we going to see more bankruptcies, more store closures, because they simply cannot compete with the much larger players?
Shauna, and you referenced it well earlier, there's a real need for Kroger and Albertsons to combine to be the first true supermarket chain to have the size and the scale to compete with Walmart, Costco, Aldi, Amazon, which between the 4 of them control over half the sales. And Walmart is significantly ahead of Kroger and Albertsons at this point. Also, Kroger and Albertsons share their private label manufacturing capacity with other independently owned chains, family-owned and operated chains, co-ops. My Flickinger family forefathers and relatives co-founded IGA, founded Red and White, founded Federated Foods through Revco, which they also co-founded, started Trader Joe's. And the National Grocers Association is made up of many of these independents, which will benefit. And in fact, in the state of Minnesota, which is opposing this deal, where we've worked closely with the unions, closely with the chains, closely with the independents, before Kroger bought Roundy's out of Wisconsin and Illinois, Rainbow Foods, which was owned by Roundy's, went bankrupt and liquidated in Minnesota. That would have never happened had Kroger come in earlier and bought Rainbow stores and had not let the prior owner run them into bankruptcy. So Kroger Albertsons is pro-consumer, pro-worker, pro-supplier, pro-community. And a lot of those shopping centers that Kroger and Albertsons saves, Shauna, pay the school taxes for the public school education in just about every state across America. So it's good for the competition. It'll lower prices. Kroger's lowered prices $5 billion in the last 20 years and has increased middle-class workers' living standards by having over 110,000 union employees, where many of the other unionized employers and unions have contracted. And the unions in the supermarket sector have lost over 150,000 jobs in a study we recently completed at Strategic Resource Group with the help of Cornell Industrial and Labor Relations and the U.S. Department of Labor. So it's good all the way around, and happy to testify and for any of the state AGs, the Federal Trade Commission, as we've done frequently in the past.
So, Bert, I called the National Grocers Association the other day just to get their perspective, and they take the other side of it. Obviously, no surprise there. But they're arguing, though, that this is going, if we do see Kroger and Albertsons deal go through, that it is going to increase anti-competitive buyer power over some of those suppliers, which is eventually then going to harm consumers. You don't see any risk of that?
No, Shauna, because I, in fact, work for a number of the independents and co-ops that supply the chains that are and family-owned and operated and single-store in independents. And those chains were discriminated against by the national brand manufacturers the same way Kroger and Albertsons was during the COVID pandemic, while the supercenter and wholesale club operators were getting just about everything that those respective food retail competitors had ordered. So, and I know from our extensive work in private label manufacturing and sourcing that everybody benefits from supermarket sector sharing sourcing from the farms to the food warehouses, to the food manufacturers, to the food stores. And there's some unique members of the National Grocers Association that are raising some concerns, but at the same time, SM Flickinger Company created over 10,000 independents in the U.S. and Canada between IGA and Red and White, and being very close to those independents. It's very pro-independent for Kroger and Albertsons to combine rather than just let Walmart, Costco, and Amazon steamroll across America and crush independent and chain and co-op food retailers in the process.
So, Bert, the odds that this deal is going to get FTC approval, what do you think?
I think the FTC is very enlightened. It's had no enforcement, in my professional view, in prior FTC regimes in terms of anti-competitive practices and predatory pricing. And to your good point, Shauna, buying practices which are brutal in the case of Walmart and in the case of Costco. Bob Ortega and Stephen Greenhouse, in the respective books coming out of the Wall Street Journal and the New York Times, have brilliantly written how Walmart's destroyed a lot of American manufacturers through their brutal buying practices in the past. Doug McMillon, the current CEO, is very enlightened and very magnanimous, but historically, Walmart's had a checkered past. So it's better to have at least a supermarket chain with national clout, and Kroger and Albertsons support local vendors from Paul's Chicken and Boise, Idaho, to Grater's Ice Cream in Ohio, to Murray's Cheese out of Greenwich Village in New York. And my great-grandfather started when Barney Kroger had one store and Joe Albertson had one store. They all worked together to help independents, and they'll continue to do so.
We, of course, will continue to track this story. Bert Flickinger, always great to get your perspective. Thanks.
Thank you, Shauna. Thank you, Diane.
All right. Well, coming up, we continue our week-long special Retail Evolution, the New Era, and check in on the state of luxury brands. We'll be right back. Coach owner Tapestry out with quarterly results this morning, missing estimates on both the top and bottom line. The retailer's revenue in North America declining, but gross profit margin did come in above the street's expectations. Fiscal year guidance for Tapestry trailing what the street was looking for. Now, these results coming as the retailers navigate shifting consumer spending amid much economic uncertainty. So what's in store for the luxury retail here after we are coming off a record year? We want to break all of this down as part of Yahoo Finance's week-long special Retail Evolution, the New Era. Joining us now to discuss, we want to bring in Pauline Brown, former LVMH chairman of North America. Pauline, it's great to have you here in studio. So let's start with what we just heard from Tapestry this morning, because they did see a decline in sales for North America. Are we starting to see the U.S. consumer, the luxury consumer, weaken even more than we had expected?
Well, I actually think we're starting to see it get better. I think 2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner. Not to say every player, including Tapestry, are going to ride that wave, but I think some of the bigger ones. Well, I think it's very brand specific. So when I look at high performing brands, Chanel, Hermes, Cartier, I think they're doing quite well again. The confidence in the market is back. The stock market is doing certainly better than it was a year ago this time. But when I look at the second tier brands, which sadly for Tapestry, I think they fall in that camp.
So let me ask you, with the deal they've made with Capri, and gaining, say, Kors and Jimmy Choo, does it give Tapestry enough scale? Because clearly they're trying to compete with, say, the scale of an LVMH. Does it give it enough scale?
No, does not, unfortunately. It gives it more scale. It almost doubles the business, but it's still, as a percentage of personal luxury spend, probably about 3% to LVMH's 16, 18%, depending on how you measure. And the quality of the brands, of those 6 brands and the new Tapestry combined portfolio, are not that great.
So who do they need to buy then to kind of beef it up and compete?
Oh, I mean, if I were CEO and if I had my druthers, I'd try to merge now with Ralph Lauren. I think that would be a match made in heaven.
When it comes to so much consolidation within the sector, you talk about the fact that the leaders here, LVMH obviously being one of the leaders, if not the leader in this space, is that going to force even more consolidation down the line? And what does that look like outside of names like Tapestry and potentially Ralph Lauren?
Yeah, it is forcing activity, and in some cases unhealthily. So if you look at Kering, which is the number 2 player, by far number 2. So there's a huge gap and a growing gap between LVMH and Kering. They have been very acquisitive of late. They have made a big push into beauty, first time ever. They acquired Creed, which is a fragrance brand. They are rumored to be in talks with CAA, which would be interesting if that happened. And they just took a 30% stake in Valentino. And they did all 3 in a relatively short period of time. So already we see it even among the second and third tier brands, a lot of activity. But unfortunately for all of them, they just can't catch up with LVMH in breadth or depth.
And so who are the losers in this kind of environment where you say, because you said you see, trends of, I guess, luxury holding up and in fact picking up. Who is, who's the laggard here?
Well, if you look past just fashion in luxury or jewelry and watches, I think the losers are those that are not doubling down on the real premium side of the market. It's Estee Lauder. Estee Lauder has lost its differentiation with some of its mass competitors. I was at Estee Lauder earlier in my career. When I was there was such a clear divide between what we called mass and class. And we didn't see L'Oreal, for example, as our arch competitor. We saw their Lancôme division as a competitor. Nowadays, I think the big mass brands have really closed the gap.
How do you see, or I guess, who's best positioned to navigate the slowdown over in China? We know that this is such a critical market when it comes to luxury retail. Certainly, the slowdown seems like news out of China getting worse and worse by the day. What's the ripple effect?
Well, I think there are two things that will stave off a disaster for those luxury brands that have depended on Chinese growth. One are going to be those that are, I would say, not over-distributed. So Hermes has been very disciplined for much of its history. They have a lot of appeal among Chinese, but they certainly have more demand than supply. I think for a brand like Vuitton, they're exposed. I think most of the brands are heavily exposed, and I go back to Estee Lauder, overexposed. The other one I would say is the brands who have tried too hard to appeal to multiple generations are struggling more than those who have taken a narrow focus of the market and really done it well. I go back to Hermes as a best in class.
And one question I want to ask you about that has been impacting, particularly when you think about retail across the board, is organized crime and this theft issue. For the luxury retailers or the luxury brands, how much of a problem is that when you think about how often where the crime happens is at the retailer, like a Nordstrom? We see viral video after viral video of this. Where is, I don't know if it's the responsibility, and what does that do to the brand itself? Does it dilute the brand at all? I mean, I can't see it doing that, but you know.
Above all, what it dilutes is the appetite of consumers to walk into the store. The city that has been hardest hit by proliferation of crime is San Francisco. And you look at all the closings, especially in the premium, but also more mass market like Gap has pulled out. It's their home market, and they're pulling out. And some of that is because you lose a lot of the economics when you have these rampant crimes, and some of it is because you don't get the traffic anymore. But I don't think of that as a nationwide crisis. I think it's very city specific.
Okay.
All right. You don't think that's interesting, because we were talking to a guest yesterday who was saying that it's very widespread, and he's expecting it to get much worse even than it is right now.
It might depend on the category. One of the issues California is so susceptible is the laws that are not necessarily in favor of retailers. And many of them have a policy, someone comes in, there's not much you can do.
Right. Certainly. All right. Well, Pauline Brown, always great to get your
you.
perspective on luxury retail. Thanks so much for hopping in studio.
Good to see you.
All right. Well, inflation's impact on the U.S. economy has resulted in a wide variation in prices for goods and services. Overall, many items have gotten more expensive, but we're finally seeing some price declines. Here to tell us where prices are coming down is Yahoo Finance's Rick Newman. Rick?
Hey, guys. So since inflation started to become an economic problem about 2 years ago, I've been tracking 27 different categories to see where inflation is worse and where it's better. And for most of this time during the last 2 years, not everything has been 8% or 20% inflation. Some of it has just been 2 or 3%, but almost all prices were up. And in the latest readings for July, I just ran through the analysis today. Of those 27 categories, more than 1/3 of them now are showing price declines over the last year. And I'll just tick off some of the areas. I'll tick off all of them, to tell you the truth. Airfare, appliances, electronics, furniture, medical care, rental cars, school books and supplies, toys, transportation, and used vehicles. Now, two important categories are not on that list, which means prices are still going up. That is food and rent. Rent is the biggest expenditure for most families, rent or housing, and food is obviously a big one. So, Americans aren't getting total relief here, but it's very encouraging that we're seeing the price of some things coming down because there's a big difference between disinflation, which only means that the rate of inflation is going lower. Prices are still going up just by less than they were before. And what we're seeing in these other categories is actual deflation, which is prices coming down. So in order for consumers to claw back some of the purchasing power they've lost over the last 2.5 years, we actually need to see prices coming down in some categories. And the good news is they are.
Ooh, Rick, I like what I'm hearing about the airline prices coming down. So hopefully we keep seeing that trending, accelerating. Well, I don't know, whatever. Rick Newman, thanks so much for doing that deep dive on prices.
See you guys.
All right. We have some of the top trending stories of the day. Alec and Al, Josh Schaefer here to tell us what's on tap. Allie and Josh, take it away.
Hi, Diane. Well, we know that Disney is seeking strategic partners for ESPN. Could it be Apple?
And one Wall Street analyst has the price for how much it might actually cost. We'll bring that to you next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined once again by Josh Schaefer and Brooke DePalma. We have quite a few stories today. I want to kick us off with Apple because we have an analyst, Wedbush analyst Dan Ives, saying that he believes it would be a, quote, no-brainer for Apple to go ahead and acquire ESPN from Disney. Now, we do know that Disney CEO Bob Iger currently seeking strategic partnerships. That could be a positive for Apple as well. Dan Ives says the cost of ESPN would be $50 billion, which ain't cheap. However,
Apple?
he says that, I mean, Apple, if anyone can afford it, it's Apple.
Apple has the money.
Has the money, and that it would be good when they're trying to shore up Apple TV Plus, especially since they already have some exposure to Major League sports, that sort of thing. But I know you have a hot take.
I don't have a hot take. I just don't fully agree with it. And I mean, Dan calls it a no-brainer, but then also lists several reasons why it doesn't really follow how Apple has built out other products. Apple is not a big M&A player when it comes to making a massive purchase like this.
Yes.
He points out really the biggest M&A play they ever made was $3 billion for Beats. And I don't know if Apple went back if they would make that purchase again. And so you wonder, you know, why would you pay $50 billion for a sports asset? Also, when we're talking about this deal, are you getting ESPN without ABC? Or are you getting ESPN and the linear TV network? Because right now, ESPN works very well because part of what they do with those sports properties is put them on ABC for everyone to see, and that's part of what you're building out, right? So what are you getting for $50 billion? I have a lot of questions.
And that point is an interesting one because right now there's a lot of talk on Wall Street whether or not Disney should be broken up. Should it be split into two companies, one with the linear networks, one with ESPN? But analysts that I've spoken with have said the same thing. How does ESPN work without the linear networks and vice versa? Where's the value in that?
And I also feel like ABC and ESPN obviously so integrated here. When you think about sort of the attractions that we've seen in Florida, when you think about how the parks have been doing, how those attractions have been doing overall, when you think about the allure of ESPN and you think about just how interconnected they are, I just don't really see them breaking up at this time. I think that it's a crucial part of ABC's operation, Disney overall, and I just don't see exactly how you could break up this huge powerhouse that's been in partnership now forever, it seems.
I think for me, it's just like if I'm Apple, why would I want to do this? I guess, like, yes, obviously it would bring more people to Apple TV Plus, right? But they're in the business of making in the business of making a profit too. And you're gonna have to keep paying for more of these sports streaming rights that keep getting more expensive. Right now, there's a lot of streamers trying to figure out what to do with their large libraries of content, and Apple isn't really in that game necessarily, right? When we talk about the streamers, it's not like they have a massive library.
No,
and they're
very
that has not been the strategy at Apple. It has been, we make high quality products.
Over quantity, and they don't pour nearly as much money into their content as some of the competitors. And there is this notion that, oh, well, don't worry, the FANG companies will come in and save linear and save all these things because they have the money to do it. But to your point, why?
Well, they didn't go in and save college football when college football wanted them to, right? Everyone wanted Apple to go and pay more money than they should have for Pac-12 teams, and when it came down to it, Apple said no. The schools came back, and one of the reports was that they asked for $50 million, and Apple said, we're not paying you that much, because that's not how they really operate as a company.
It's really easy to say, yeah, sure, Apple will buy this, because they can afford it.
They can afford it, but it wouldn't necessarily work for them. It wouldn't necessarily boost their subscriber numbers. Would it necessarily bring people onto the platform? Like we're all saying, I don't think so, because there's still an existing linear that people are very loyal to. And I think about, older consumers that I don't think they necessarily make the change to Apple Plus should this happen, should this deal go through.
And I don't even know if Disney's CEO Bob Iger would want to sell, because right now he's maintained ESPN is going to be a fully over-the-top streaming service.
And he's talked a lot about how sports are a big part of their vision.
Yes.
Like, I mean, maybe he's just being a salesman because he wants to sell it, right? But he's certainly, you listen to that earnings call, he played up sports a lot.
But he's also said linear networks stink, and he's like, but we'll sell that. So I don't know.
And also, too, Dan Ives did point out to the relationship between Iger and Cook, and I thought that was pretty interesting just to hear about, how exactly they could build on this relationship. So maybe we won't see this partnership, but maybe we could see something.
Sports on the Vision Pro, I'm telling you. Sports on the Vision Pro.
Maybe it could happen.
Iger was at the event.
Right.
He's like, and he's teased that several times, saying that. So I do think that's certainly a possibility.
Absolutely.
Maybe Apple should buy Peloton.
Oh, okay.
All right, that's not a real transition. I just want to talk about Peloton. There's an interesting story out in Bloomberg today about Peloton. One of a new strategy is at Peloton called Peloton for Business. And essentially what they're doing now is they're trying to market their product more to businesses. And sort of like how a lot of healthcare plans now at businesses get you maybe a discounted membership at a gym or provide something from a gym standpoint, Peloton now wants to do that, maybe give members or workers free access to the app, not necessarily hardware, but then if you're on the app at work, then maybe you want to get the bike at home for all these split life people. That's kind of where I see it going.
Yeah.
Interesting to see the stock reaction today on this report. Peloton down 4%, so I don't really think it had much of an impact on it. I think there was a time in Peloton's big stock run where reports like this actually did have an impact on the stock and it used to act a little different. So that to me sort of paints a picture of where Peloton is at right now, that news like this isn't quite moving the stock anymore. It's kind of bleak out there.
Yeah, and bleak outlook, I think, overall. I mean, if you're thinking about all the ways that Peloton could grow, Peloton for Business, I mean, it makes sense. And it's not just offices, also like luxury apartment buildings, things like that. That could be enticing for certain people that are into that. But I just think it's post-pandemic, it's just different. People are going out there to, we were just talking yesterday about lifetime gym membership and paying more for that gym membership that could also serve as a home office. So consumer behavior patterns are a little bit different too.
Yeah, I was just going to weigh on that, is that I feel like, post-pandemic, we're certainly seeing a completely different consumer behavior than what we saw pre-pandemic. But even now, some of those COVID-19 trends that we saw of people really working out at home are certainly evolving. People want to get back out. People want to be involved. And so when you think of those high-end, luxury apartment buildings, they already have them in the apartment buildings. So they're really just looking to capitalize further of them. And the release said that it's regardless of size of the company, regardless of client needs. I feel like Peloton really here just trying to get a footing on where they should go from here.
Well, it kind of reminds me of when they started selling on Amazon too, and it's something that makes sense for the business and scaling for the business, but it takes away from what the Peloton brand was, at least initially to me. It seemed like it was more of a luxury play, right? And now you're gonna be offering across businesses to just any worker. It's not quite the high-end bike that they once sort of had painted.
I
and that
sort of disagree
brand
with you. I feel
painted.
like during the pandemic, it really got run up as like a everyday person, affordable option. I mean,
Brooke, the bikes are like $2,000.
But at the same time,
and then you have to pay for the membership.
When I was in suburbia during the pandemic, I saw a Peloton truck every single day. And so it seemed like it was like an everyday play, at least in suburbia land in New York.
I was going to say, a nice neighborhood maybe where people were
at the same time, it is a costly option, as you're noting. And when people are now paying for gym memberships again, post-pandemic, people are really budgeting, people are really strategizing where exactly they're going to put their dollar forth. And so ultimately, Peloton struggling to make it seem like it's worth it for the everyday person.
Well, when I work out at home, I'm going on YouTube. I'm not paying for anything. And the YouTube workouts,
always
chef's
good.
Kiss. Like, they're really good. I gotta say,
no, these influencers have stepped up their game.
I did like a YouTube workout a couple weeks ago. I mean, I do work out more than that, but
a couple weeks ago.
3 weeks ago. Yeah.
Just one time.
I don't work out all the time, but it was very good, and I feel like maybe that's a new age. Like, you don't necessarily need to pay a Peloton membership fee to work out at home. You could easily just go to the gym if you want that option, but there's other free options as well.
Well, I'll tell you, I'll be hitting the gym more because it may or may not be officially pumpkin spice latte season. I mean, we're seeing so many companies. We saw Wendy's reportedly potentially launching a pumpkin spice frosty.
I'm out.
Now you're out?
I'm
you're
out.
Okay,
I'm
Josh is out
definitively
already. Josh is out
definitively
already.
out on ice cream pumpkin. I'm out on most things. I'm definitely out on pumpkin flavored ice cream.
That like doesn't surprise me.
Well, maybe this. So Dunkin' also launching their pumpkin cold brew. They're bringing it back starting today. I mean, the date, I have to look. It's August 17th. Is it too early for the pumpkin spice
I think it's
season?
too early.
We have this conversation
a month.
every year.
Yeah, a month away.
It's too early for a hot pumpkin spice latte.
Maybe a cold. Cold beverages are.
Cold, I think cold like always plays, right? Like anything that's in the ice, sure, it's cold enough, but like a hot pumpkin spice latte today when it's 85 degrees, I don't think that's gonna. And I drink hot coffee in the morning still.
But this is because I went into a store and there were Halloween decorations out and there were options to buy Halloween fall stuff. Now I am a fan of fall. My friends call me fall girl.
Oh.
So I
didn't realize this. You really lean in.
I really leaned in. And like, this is actually a funny story. In college, I got a Halloween costume, and it literally was like a fall girl costume. I spent way too much money on it.
Interesting.
And my friends were like, "Why?"
Did you buy it in August?
I bought it in like September, October. But anyway, the name stuck. So I'm a fall fan. Okay. But I do think early August is a little too soon. I think once you get to the end of August, once football starts to become more a part of the dialogue
football
and
is
the
the start of fall.
conversation, people start talking about their brackets already on Yahoo Finance. People are talking about, you know, fantasy and all that. I do see why that comes into
And also, too, these retailers as well as the fast food giants, I mean, this was a short promotional period that used to be pumpkin spice latte season. And now, I mean, they saw how well it did during those, say, 2 weeks, 2 months. And now it's just sort of stretched out where they're doing it from now until December.
That's what I'll be most curious about if we can get some insight into that in the next couple earnings calls is how do the pumpkin spice lattes sell in August? Because if they sell well,
people might just it's only a week or so.
Right, but like in August and even September, you know what I mean? Like in September, it's still a massive month, and like, yeah, I get it.
It always is a spike, though. It's always a spike.
And also what's interesting, too, is just people adding that pumpkin sauce. We're seeing that at Dunkin', we're seeing that at Starbucks eventually when it does come out. And I think that's also interesting, too, just people wanting that pumpkin flavor. I'll admit, I'm a fan, but not a huge fan.
Black coffee.
Yeah, I'm more
coffee
of a black
is meant
coffee
to be drank
too.
black.
And before we know it, it'll be Christmas and Hanukkah. So just stay tight.
And then
tight.
it's gingerbread season.
Exactly.
So, you know, we're moving right along.
I'm in on that one.
All right, we got you. So we're going to gingerbread out on pumpkin.
We'll get to that one.
Okay, all right, got it. Well, that's it for us today. Coming up on the other side of this break, we have much more Yahoo Finance. Stay tuned.
Earlier this week, Intel announced that it has mutually agreed with Tower Semiconductor to terminate its previously disclosed agreement to acquire Tower after China's antitrust regulators failed to rule on the transaction before a deadline that's set by the companies. Now, Intel CEO Pat Gelsinger sat down with Yahoo Finance's Akiko Fujita to discuss the barriers and regulations behind the fallout of the deal and the future of M&As in the industry. Take a listen.
Unfortunately, we weren't able to get approval for the Tower acquisition. And as I would say, it was simply caught in this, center of US, China, or the geopolitics going on. We're disappointed by that because being able to acquire a foundry company like Tower would have accelerated. My ambitions to be a foundry weren't dependent on the deal, but they would have been accelerated by it. So simply put, I have to find other ways to drive the agenda because it's not likely that any major technology acquisition, will get regulatory approval. And I think that's disappointing because M&A has always been a factor in how technology companies have been, building and moving their strategies forward. And it's unfortunate, that that's become a consequence of the current geopolitical tensions. And for us, it will slow me down in some aspects, but my strategy is not dependent on getting this particular deal done. It would only be helped and accelerated by that. And we're going to find other ways to keep moving our strategy forward in light of that.
If M&A isn't in play because of the regulatory environment, what are the other ways?
Business partnerships, winning customers, building capabilities organically. But I do think that this consequence of the M&A no longer being available for companies, and this isn't an Intel statement, this is an industry statement, I think is an unfortunate consequence of the current geopolitical situation. And, part of the reason that we've advised, I'll say, balance and temperance on both sides. We need the U.S. and Chinese collaborating, discussing with each other. These are the two largest economies in the world. I've been to China twice. I'm the chair of the U.S. Chamber's China Center because we believe there needs to be this bridge between these two important economies of the world. And, I've personally stepped into that role to help to play some of that bridging role. Obviously, visits by the various cabinet members, Yellen and Blinken recently, Kerry, and I think Raimondo later this month. All of these, I believe, are very positive steps. Let's at least have the real conversations going on.
You alluded to the fact that, this is an industry that is global. And as we have seen the geopolitical side of this play out, we've learned that, whether it is in Europe, whether it is in Asia, whether it's in the U.S., if there are barriers that are being drawn up, does that ultimately hurt innovation in this space? You look at the U.S. The U.S. has excelled in the design of chips. Manufacturing may be in Asia, but the U.S. provides the machines that allow for that. We've seen that in Europe, too. What happens when those barriers start to go up because of geopolitics?
I do think that it has a negative implication on the innovative cycle for the world in that regard. And I think, like in areas of AI, we've seen that the U.S. has led, right, profoundly. So all the major AI innovations, despite some declaring that wouldn't be the case, even just a few years ago, right, that China was going to win in that race. Well, hasn't worked out to be the case. I believe fundamentally because of the open, innovative, somewhat chaotic cycle that we have and the very aggressive venture and entrepreneurial aspects that we bring to the table. And I think that's best served by largely open global markets. And, and I believe that history has demonstrated that time and time again, that that's the best way to, approach global policy for markets. Semiconductors are one of the largest export items for the American economy now. One of our largest exports to China, only number 2 to soybeans. This is big. This is important. And if we're going to be a global manufacturer at scale, we need access to global markets. We need to continue to invest in our long-term research. Another aspect of the CHIPS Act was those long-term research investments as well. So let's be ahead today. Let's plant the seed corn to be ahead tomorrow. And let's underpin it with manufacturing at scale.
All right, that was our Kiko Fujita with Intel CEO Pat Gelsinger. Coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned. Let's take a look at what's trending after hours. We got 3 stocks for you: Raw Stores, Applied Materials, and Moderna. Kicking off with Raw Stores, we're looking at a gain of just over 6% here in extended trading. A very solid earnings report here from the company. They also raised their earnings and sales outlook for the year, and they now expect positive same-store sales for the year, seeing growth of 2 to 3%. Now that was up from what they were initially expecting, which was a flat sales for the year. When you take a look at the numbers for the second quarter, sales coming in at $4.93 billion. That's up 7% from just a year ago. Comp sales blowing past expectations, growing just about 5% for the quarter. We're looking at gains of nearly 9% in the last 3 months. When you take a look at that year-to-date chart, we have seen Raw Stores gain a bit of momentum since hovering right around its lows of the year back in June. So it closed today right around $113 this share. We'll see whether or not this momentum after hours sticks for the opening bell tomorrow. Let's take a look at Applied Materials, a look here at the chip sector. And we're looking at gains of nearly 2% in extended trading, a strong forecast here from Applied Materials. Also another sign that maybe the slump that we've seen in the chip sector, that it might continue to fade just a little bit. Now the company also beat on the top and bottom line for its fiscal third quarter, earnings of $1.90 a share, sales of $6.43 billion. That came in better than the street was looking for, but it did decline by about just about 1.5% from a year ago. And rounding it out with Moderna, we're looking at losses of just about 0.1%, but a headline here crossing in after hours trading. The company saying that its prelim trial data showed that its updated COVID vaccine generates robust immune response, and that they're expecting the updated vaccine expected in coming weeks pending approval, obviously. Now this is a stock that's lost a lot of its momentum as we have seen demand for the COVID vaccine really continue to wane. We're looking at losses of just about 40% year to date over the last year. Slightly less there, off just about 32%, but we certainly have seen this steady decline since the start of the year. Lots of concern just about what that demand picture is going to look like for Moderna for its vaccine here in the future. All right. It is closing time at Yahoo Finance. Here's a look at some of the top stories of the day. CVS, one of the top trending tickers all day. The stock dropping after Blue Shield California said it's going to drop the company's pharmacy benefit management services in an effort to save costs. The insurer will now partner with Amazon Pharmacy and Mark Cuban's company, Cost Plus Drugs, for at-home drug delivery and low-cost drugs. Now, this isn't a complete loss for CVS. It will still handle specialty pharmacy services. And JP Morgan Chase says this is actually the most critical piece of the business, and it demonstrates the value of legacy pharmacy benefit managers. The United Auto Workers Union set to vote to authorize a strike next week, and a new estimate shows just how big of a hit a stoppage could have on the economy. The Anderson Economic Group says the strike will cost $5 billion after just 10 days. The current contract between the UAW and the big three automakers, Ford, GM, and Stellantis, expires at 11:59 p.m. on September 14th. Plus, SpaceX reportedly now profitable. The Wall Street Journal saying Elon Musk's space startup turning a profit in the first quarter thanks to a surge in revenue. This rare look at SpaceX's finances shows how the company is faring as it ramps up its Starlink satellite service. All right, time now for What to Watch Friday. Palo Alto Networks has taken the unusual step and plans to report results after the close on Friday. Wedbush analyst Dan Ives calling this a, quote, disaster timing move for the ages and also a head scratcher. Now, Ives adding that it's one of the biggest PR disasters that he has seen in decades of covering tech. The street fearing that this could potentially signal bad news. And then we also got more on the earnings front tomorrow. Estee Lauder will report results before the bell. Traders are looking for any updates on sales in Asia as the company looks to catch up to rivals such as L'Oreal. And on the political front, President Biden to meet with leaders of Japan and South Korea at Camp David. The president looking to solidify key ties in the first ever trilateral meeting that we'll have there. All right, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow afternoon. Have a great day.